Let's start with the scoreboard. The broad indices show cautious optimism, but the internal strength is uneven. The S&P 500, SPY, nudged up by just 0.27% to 692.24. The tech-heavy Nasdaq proxy, QQQ, saw a slightly better performance, gaining 0.36% to 621.78. But the real winner in the headline indices today is the small-cap Russell 2000 proxy, IWM, which jumped a robust 0.88% to 265.51. This tells a story of rotation. Money is flowing out of the mega-cap tech darlings, perhaps seeking better value or simply chasing the momentum in smaller, more domestically focused businesses. However, the big story, the one dominating news feeds and analyst commentary, is the continued, almost manic focus on artificial intelligence. NVIDIA, the titan of the chip world, is flying high again, up 2.13% to $187.05. This is a pure momentum play, a gravitational pull that keeps the broader market tethered, despite other weak links. We see weakness where you might not expect it. Apple, AAPL, is down 0.67% and Microsoft, MSFT, is easing back 0.59%. These giants, often seen as stable anchors, are taking a breather, possibly due to investor fatigue or perhaps concerns that the AI narrative is overshadowing other aspects of their business. Tesla, TSLA, meanwhile, continues its sluggish drift, down 0.14%. The AI hype train is selectively hitting the tracks, clearly favoring the pure infrastructure plays over the application layer right now. The VIX, the fear gauge, is ticking down by 2.02% to 15.52. A lower VIX suggests complacency is settling in, perhaps encouraged by that modest uptick in the major indices and the resilience of the NVDA stock price. The market feels less worried about an immediate crash, opting instead for a slow, grinding climb, punctuated by sector rotation. The narrative shaping today's movements is deeply rooted in two powerful forces: persistent economic data and intense political influence. On the data front, we have fresh CPI numbers showing US inflation holding steady at 2.7%. This isn't a massive shock, but it confirms the sticky nature of current inflation levels. This steadiness is what the Federal Reserve has been observing. Curiously, this comes alongside a report showing weekly jobless claims fell unexpectedly, suggesting the labor market is still tight, yet Reuters notes the market is treading water. The market is absorbing the fact that while inflation isn't accelerating rapidly, it's also not rapidly retreating to the Fed's target. This backdrop creates fertile ground for political speculation, especially concerning the Fed. We have an entire explainer dedicated to the dynamic between Donald Trump and the Federal Reserve, focusing on the implications should Trump pursue his agenda regarding Fed leadership, specifically Chairman Jerome Powell. This political uncertainty adds a layer of background noise that bond traders hate. Meanwhile, globally, Christine Lagarde at the ECB is signaling a steady rate path, but she's acutely aware that the Fed tussle remains a significant external risk. The central banks are trying to manage their domestic situations while navigating the geopolitical and political minefields emanating from Washington. We also heard from some titans. Jamie Dimon of JP Morgan signaling he wants to stay put for 5 more years suggests stability at the helm of a major financial institution, which generally calms institutional investors. Conversely, the dynamic around Jensen Huang at Nvidia is electric. He's actively framing the AI revolution not as a job killer, but as a necessary technological shift, a masterful piece of narrative control designed to keep the investment thesis pristine. But not everyone is bullish on the current AI euphoria. We must note Michael Burry, who, according to Yahoo Finance, is betting against Nvidia, stating, "I do not see how that math works." This is the classic conflict. The institutional momentum driven by perceived necessity versus the skeptical value assessment of a legendary contrarian. If you want to understand the true sentiment about future growth and inflation expectations, you look at the Treasury market. And here, the signals are loud and clear. Expectations for higher rates are hardening. The 10-year Treasury yield, TNX, is up 0.48%, closing in on 4.16%. This yield increase is crucial. When the 10-year rises, it signals that investors demand greater compensation for holding long-term government debt, often because they anticipate persistent inflation or robust growth that might force the Fed to keep rates higher for longer. This upward pressure on the long end of the curve is directly influencing housing sentiment. We see headlines discussing how Trump's desire for Fannie Mae and Freddie Mac to buy more bonds aims to lower mortgage rates, directly targeting the cost of housing finance. This entire mechanism hinges on the 10-year yield. A rising TNX makes mortgage-backed securities less attractive and pushes those mortgage rates higher, which feeds into discussions about the housing market mechanics. The underlying tension is palpable. Is the economy strong enough to support these yields, as GS projects 2026 GDP growth to outperform forecasts, or is the bond market overreacting to political noise? Right now, the latter seems to be taking a backseat to the growth narrative. The Federal Reserve remains the undisputed gravitational center of the financial world, and the political climate surrounding it is heating up. The ongoing tension surrounding Jerome Powell's tenure, exacerbated by political maneuvering, creates an environment where market participants must price in not just economic data, but potential governance shifts. We see IMF chief Kristalina Georgieva backing Powell and stressing central bank independence, a standard, necessary defense of the institution against political encroachment. This struggle between established independence and external political will is a huge wild card for fixed income traders. Simultaneously, the ECB is watching closely. They are trying to chart an independent course, but as Lagarde's chief economist noted, the Fed's actions, or the perception of its political environment, creates systemic risk for everyone else. If the US is seen as potentially sacrificing Fed independence for political expediency, the resulting uncertainty can spill over globally, causing dollar volatility, which we observe slightly today as the dollar index, DXY, NYB, is marginally lower at 99.26, suggesting a very slight cooling of the dollar's recent strength. The commodities complex is telling a story of divergent pressures. Energy is up, precious metals are down, and the dollar's slight easing is having a muted effect. Crude oil, CL=F, is enjoying a solid day, gaining 1.17% to $59.88 a barrel. This rise suggests strong demand expectations, potentially fueled by that surprisingly resilient US labor market data and perhaps inventory shifts we aren't seeing in the headline news. When energy prices climb, it adds an inflationary layer that the Fed must confront, reinforcing the sticky inflation narrative we discussed earlier. However, gold, GC=F, is retreating, down 0.24% to $4,605.30. Gold typically thrives when real interest rates are low or when fear of systemic collapse is high. The fact that it's declining alongside rising Treasury yields and a slightly calming VIX indicates that the fear element is receding. Investors are choosing yield, bonds, stocks, over the non-yielding safe haven of gold. On the currency front, the euro, or USD=X, is down slightly at 1.16, reflecting that the Fed narrative, even with the political turbulence, still anchors global capital flows relative to the Eurozone. The market divergence is clearest in the sector rotation. As mentioned, the small caps, IWM, are leading, suggesting investors are finding better risk-reward profiles outside the mega-cap orbit. The AI fervor is entirely focused on the chip designers and infrastructure providers, exemplified by NVIDIA's massive outperformance. This is where capital is being aggressively deployed, validated by quotes from CEOs like Jensen Huang arguing AI is a catalyst, not a destructive force. In stark contrast, look at the software giants. AAPL and MSFT are easing. This isn't necessarily a crisis, it's a correction after massive runs. Investors are taking profits from the established giants and reallocating into names where the AI story offers more immediate, explosive growth potential, or perhaps rotating into cyclicals that benefit from the resilient underlying economy suggested by the lower jobless claims. We also see some interesting moves among the money managers. Cathie Wood's ARK Invest is selling Tesla, but importantly, doubling down on another semi-stock, suggesting she remains pro-technology but is actively picking specific lanes, moving away from Musk's story for now. Meanwhile, Warren Buffett's enduring picks are being discussed, reinforcing the flight to quality, even if that quality isn't currently capturing the day's biggest headlines. Cryptocurrency presents a fascinating counter-narrative today, highly sensitive to institutional sentiment and regulatory chatter. Bitcoin, BTC/USD, is down 0.27% to $95,293, and Ethereum, ETH/USD, is down further at minus 0.58% to $3,297. This weakness coincides precisely with negative regulatory news. The U.S. Senate Banking Committee cancelled a crypto market structure markup. This bureaucratic delay is interpreted as a setback for clarity and potentially favorable regulation, causing a dip. This contrasts sharply with the general market feeling of treading water or moderate optimism. Crypto, being inherently more speculative and less tethered to immediate CPI readings, is extremely sensitive to political headwinds. Nouriel Roubini's skepticism remains a constant narrative hum, even as figures like Michael Saylor continue to champion Bitcoin's long-term store of value proposition. It's also interesting to note Cathie Wood's recent prediction, where she calls Bitcoin the ultimate diversifier for a potential 5% GDP boom coupled with deflation, a fascinating, highly specific scenario. For now, however, the market is reacting more to the lack of immediate regulatory progress than to these long-term, bullish theses. Looking forward, the market needs a cohesive story to drive it decisively in one direction. Right now, we have conflicting data points fighting the narrative pull of AI megacaps. The immediate focus will be on how the bond market digests the relatively stable 2.7% inflation number against the rising 10-year yield. If the yield keeps pushing higher, say, above 4.20%, it will put renewed pressure on those rate-sensitive growth stocks outside of the core AI group. We must also watch the political landscape. Any further headlines regarding the Fed's independence or specific regulatory actions, particularly those involving tech giants like the fallout Elon Musk is facing over Grok deepfakes, will translate immediately into volatility in the related stocks. Furthermore, the focus on talent wars, as seen with Zuckerberg's soup deliveries to poach AI engineers, signals that the competition for human capital in high-growth tech remains fierce, a hidden inflationary pressure in wages. We should expect continued volatility in the IWM as investors search for value, and a potential consolidation or slight pullback in NVDA unless a major new piece of AI infrastructure news drops. Today's market snapshot is one of careful compartmentalization. Investors are simultaneously embracing the technological revolution embodied by Nvidia while being sobered by sticky inflation data and political uncertainty swirling around the Federal Reserve. The market isn't panicking, it's prioritizing. It's prioritizing the high-growth narrative above all else, using the slightly softer unemployment data as justification to believe the economy can handle higher rates if necessary. Yet, the strength in small caps suggests that the confidence isn't universal. The appetite for risk is selective. The central tension remains. Can the productivity gains from AI outpace the inflationary pressure of persistent domestic demand and global commodity strength, all while navigating potential regulatory turbulence? Until the Fed gives a clearer signal, or the economic data definitively breaks one way or the other, expect this complex, rotation-heavy pattern to continue. Stay diversified, stay informed, and never let the noise drown out the underlying story. That's your market update for today.